Okay, welcome back to another Strivemont video. And today we're going to talk about how to become more profitable when playing options. So this is a little strategy that I like to do involving some risk management, and you guys should incorporate it into the way you trade, because I know I've been in your shoes where you have those days where, you made all the wrong choices, you went in with too many options, you couldn't get out, you didn't get out at a good price you wanted to, whatever it is. So let me get into it. So when it comes to trading options, you want to make sure that you have a plan, right? You don't want to go into a trade with, let's say, just automatically jumping into a trade with like more than three or more options, right? You want to get your feet wet, buy an option or two, right? So let's say I'm buying this option from Microsoft for 215 calls, right? And if we're looking at the chart right now, we see that we crossed over the SMA line. So I'm deciding, okay, before market close, let me get some 215 calls. We might have a little run up over here. So I'm not gonna buy 10 calls max, right? I'm not gonna go in and buy like 15 calls and wait till the next day to see what happens with Microsoft, right? So what you want to do, and this also depends on your portfolio size, because you want to make sure you have enough money where, let's say the stock starts to go down, you could start to lower your average price, right? That being said, this is how I like to trade. So I would go in with one or two options, get my feet wet. Let's see if the stock is going in the direction I want it to go. And as it continues to rise up, I'm adding another two options, another two options. So I'm scaling up until, it comes time to selling. So you want to target price when you want to get out, or when you start to see resistance, you want to start thinking about, okay, I should get out right now. Another thing that I want to talk about is basically how we're going to do this whole scaling, right? So let's say we're going to have two scenarios. One scenario where the option goes your way, and then you're going to plan on selling it. This is it going your way. The second scenario is the option doesn't go your way. And then that's how we look at it differently. So starting with the first scenario, let's say you buy two options. The price is going your way. You add another two. You add another two. So once you start to hit that resistance where you see the stock might start to go down, or what might be your target price, that's when you want to start scaling out of your position. So now I'm selling four options. I'm selling half of my position now. I'm selling another half of my position until I'm out, right? I wouldn't, let's say you still think the stock could run up a lot more. You don't have to sell your whole position out, but you should take some profits and lower your risk and continue to let the other options, work its way up and then scale down again. So that is the scenario as if the stock is going your way. But let's say it's not going your way and it starts going down. So let's say you bought two options, now the stock is going down, and then you're thinking, okay, now I'm starting to see a reversal happening, right? You're seeing consolidation, we're starting to make higher lows. You say, hey, now that the option is cheaper, let me buy in another two options to average down my price, right? So as you begin to average down your price and the option starts to go higher, now your risk of meeting your average cost is going to be way better than before, because it was a lot higher, that average cost. So when it starts, you don't want to be in that position where you buy like 20 contracts and then the stock starts going down, and guess what? You can't buy any more options because let's say you don't have any money in your portfolio to go and buy more options, or don't want to be in that scenario. So you buy two options, see where the stock heads. If it goes down, okay, wait for it to consolidate a bit, and then start adding on to it once you start seeing confirmation that the stock is going up. So sometimes what might end up happening when we begin to add as the stock goes down. So when we start to add as it consolidates and then starts to make its way up, like that reversal, but then it starts to go down again, that's when you want to consider cutting losses. All right. So that's it for today's video. Hope you guys enjoyed it. And as always, leave a like and subscribe.